Okay, so today's topic again very interesting. So what we are going to study is financial statement analysis, right? Now, this topic, why I'm saying is very important because when we analyze the financial statement of any company, right? What we do actually, we just analyze with the help of ratio analysis, right? Ratios are basically what? It is you compare one data with another data. So basically, what you get is basically symptoms. So, I always say that management accountant, they are the financial doctors of the company, right? Obviously, in order to analyze, understand what exactly the company is doing, what is the performance, what we should do actually, being a management accountant, so that we can correct the situation, right? So, financial statement analysis, where we will deep dive, try to identify the symptoms first. Okay, symptoms means just like we say, if you have fever, for example, right? Say, for example, that means that's a symptom that you have 102-degree temperature. Now, why 102-degree, and how we can find out the how to diagnose, right? So similarly, here also the management accountant, first they will identify the symptoms, okay, and they will correct the situation, right? Now, this ratio analysis, the financial statement analysis, is so powerful that you can definitely improve the financial position of the company also, right? We deep dive income statement. So we in India we say profit and loss account, balance sheet, whatever data comes, right? We basically try to analyze. And second thing is that only calculation of ratios are not important. You have to also deep dive and interpret the ratio. So I always emphasize that calculation to even any software can do, right? But the interpretation of ratios are very important. So for example, how you can read, say, AR turnover ratio and with the credit period, example, the AR days with credit period, operating cycle is there. You go to cash cycles, operating cycle with your net income, with gross profit, for example. You know, for example, we say that longer the cycle, operating cycle, obviously this will slow down, right? Longer the cycle, obviously cash to cash, right? Cash is converted into inventory, inventory is converted into your account receivable, and account receivable is converted into again cash. That means you'll be earning profit. One cycle is over and you'll be earning profit, right? So you purchase the goods, you convert the goods into WIP into finished good, then you sell the goods actually to your customer, and then you will be earning profit, right? Then once you receive the money, so cash cycle, cash to cash. Once you get the money, again you purchase your inventory, or you process the inventory, right? So obviously this entire cycle is there. Now, how you can compare this operating cycle, it's called operating cycle, cash to cash. How you can compare this operating cycle with the profitability of the company, right? For example, wholesaler, see the operating cycle of wholesaler. If you see the operating cycle of wholesaler, is hardly one day. They purchase material in bulk and they sell. So hardly any operating cycle is there. But how about the margin? Wafer tin margin. If you see the operating cycle is only one day. One day they can convert cash to cash. But the margin is what? Very small margin, right? How about the real estate builder? The builder basically, what is the operating cycle? Cash to cash, 3 years, 4 years, right? Obviously, how about the margin? It's very high. Very high. Otherwise, they can't afford. See, we here, the beauty of operating cycle is that you can compare one business versus another business, right? And we can compare the margin also, right? So, for example, if I earn 1% and operating cycle is one day, that means that 365 days, it is 365 percentage, right? And for example, real estate builder, right? Obviously, say 3 years is a turnaround time. Operating cycle is 3 years. Say for example, cash converted into your inventory. For inventory means they construct, right? And they sell the apartment to the customer, and after they collect the money, entire cash cycle, completes. Obviously, it takes a lot of time. It's a longer time. So what should be the margin you should expect? Now 365% is very high. 1% is also very high. I can say that wholesalers sometimes they charge only, their markup is only 0.5% or 0.25%. Don't more than that, right? So obviously, we compare the business, and then you say that okay, fine, this business is good actually. So when you are venturing into new business, or if you are planning to introduce new product, obviously we see the operating cycle, right? Operating cycle. For example, if you are enjoying monopoly, right? Definitely you ask for the advances rather than the credit period. So you can see the operating cycle, right? Uh, Even the working capital also, right? For the monopoly product, obviously you can definitely have say that okay, fine, I don't want to give credit period, and you also see the buyers also. When you are a vendor, you can negotiate with the vendor, and you can try to extend the account payable days, right? So obviously, that's an advantage that if you are enjoying monopoly, you can definitely command premium basically, right? Obviously, so we are going to learn this. This means that first of all, whenever you analyze any company's performance, you have to understand the business, right? If you don't understand the business, then whatever ratios you get is very difficult to analyze. So basically, the financial data, we are talking about financial statement analysis. No doubt, financial statement analysis is very much required, but you have to also try to connect with the non-financial data, right? Then only it makes sense. Non-financial data could be anything, right? You have to connect, right? For example, say your capacity utilization. Now, this is non-financial data. Utilization you compare with your basically contribution margin. Contribution margin means is a sales minus variable cost. So what I'm saying that you have to connect the dots, and you have to interpret the financial statement. So how you are going to interpret a financial statement? You have to learn, right? When you say compare one ratio with another ratio, for example, say net profit ratio is there. So where you will connect? You'll be connecting with return on equity, return on investment. So what I'm saying, just now I'm telling all these things, but we'll learn each and every ratios, and I want that you also start interpreting the ratios, right? Interpret the ratio basically, right? So let us start. I'll go very slow. Don't worry about that. If you have any question, you can just ask me. Not a problem, right? The first ratio, I always say that this is my, you can say, favorite ratio. Like the first ratio is, let me share the screen. No, I have not shared the screen yet. 1 minute. First ratio we say is return on equity, ROE. Return on equity, right? Obviously, for any businessman, right? For example, if I tell you that let us invest in the business, obviously you will say that how much return I should get. That's very important, right? My return is very important. Similarly, for the shareholders' point of view, also, your return on equity, whatever every $1, when we interpret a ratio, no, the denominator, for example, we say return on equity, right? So denominator is equity, right? Denominator is equity. So advantage of using the ratio analysis that you can do the competitive analysis. Why? Because when we say divided by equity, right? What exactly we are saying? We say every $1 of equity, right? Obviously, if I'm comparing uh, company A and company B also I'm saying equity, right? It means that what? every $1 of equity, how much return you are generating, right? So now return means what? The net income numerator, basically we say net income available to common shareholder. Net income available to common shareholder. It means that every $1 of equity, how much net income you are earning. So for example, you are investing $10,000 in the business, right? And your net profit is say $2,000. So can I say that, that every $1, if I divide $2,000 divided by $10,000, can I say that basically the every $1 I am earning 20 cent. Every $1 I am earning 20 cent, right? And then we convert into percentage. Centage means 100. Percentage, basically people sometimes don't understand. Percentage means every $100 how much you are earning, right? So when I'm converting into percentage, I'll be multiplying by 100 actually. 1 divided by 100, 1 multiplied by 100, 0.2 into 100, right? So every $100, percentage means 100, right? So every $100 you are 20 percentage. It means that, so basically people understand this language. 20 percentage return, basically. Centage means every $100, $20, right? Or I can say that I'm earning 20 cent per dollar. Logically, it is one and the same thing, right? Every $1 I'm earning 20 cent, which is 20 percentage, because we are used to, right? All these days we always talk about percentage. That's why we are used to that 100 percentage, right? So this is basically, it will tell that every $1 company is earning 20 percentage or 0.2 cent every dollar. So that means that now again A and B, he also write net income. So one company is say is 20 percentage, another company is say 15 percentage. It means what? Every $100 company A is earning $20, and every $100 company B is earning $15. Now you can do comparison, right? Because here equity, we are just dividing by equity. That means we are converting that every $1 that this is comparable. This platform is comparable. But I cannot say, for example, net income is $50,000 and equity is $100,000, for example, and another company here net income is say $30,000 and equity is say $20,000. I can't interpret which one is better. Just looking at 50,000, you'll say absolute number 50,000 is much greater than 30,000. You can't say that. But then when I divide by equity, that time I just try to interpret that every $1 company A is earning 50 cent or 50 percentage, and company B is basically it is 1.5 or $1 150 percentage. So now you can see that moment you calculate the ratio, you are what exactly you are doing? You are doing the comparison. You are just equating the platform, and that's why you can easily interpret that every $1 company A is earning how much, company B is earning. That's a reason. This is very powerful, right? So you can, irrespective of the size of the company, you can do the comparison, right? Can I compare Wipro versus Infosys? Answer is yes. Can I compare Infosys versus HCL Technology or small company? Yes, because I just converting everything into $100 centage, right? Or $1, whatever, right? But I want to make sure that my denominator, basically, when I'm dividing, I'm just converting to 1 unit. Every 1 unit, what is the right? Sometimes we calculate the risks, right? So per unit of risks, how much you are generating the return, right? Always say, higher the risk, higher the return, lower the risk, lower the return, right? So per unit of risk, how much you are generating the higher return. So that's something we. So obviously, return on equity is important. So every $1, how much net income company is earning for the equity shareholder or common shareholder, right? This is something which is so. This is the first step, return on equity, ROE. Now all these ratios are emanating from ROE. So for example, when you read the textbook, You'll say first liquidity ratio, then you will read the solvency, then you read the turnover ratio, then you read the profitability ratio, then you read the market ratio. So basically, everything you should know that this is emanating from one ratio only, which is called return on equity, ROE. So basically, see, I'll tell you, this is why it is important, no? When your return on equity is changing from, say, for example, last year, say it is 20 percentage, and now it is, say, 15 percentage. There is a reduction of 5 percentage, right? Obviously, then you have to find out that where is the problem. Return on equity from 20% to 50%, that means you have to deep dive and try to identify the reasons behind that. Where is the problem? Because this is reduction, right? Basically, so if it is reduced, then where is the problem? And if it is increased, say for example 20% to 25 percentage, then what exactly you have done so that your performance has improved, right? And not only that, if there is a reduction or if there is an increase, then sometimes you have to also identify that whatever things has increased or decreased, whether this was controllable or uncontrollable, right? You cannot make any person responsible if they cannot control controllable and uncontrollable, right? So obviously this is very important. So we see that, okay, fine, the reduction is 5 percentage. Obviously we deep dive and try to find out the reasons behind that, where is the problem, right? So basically we are just analyzing, right? Once we analyze, then we prescribe the medicine. Okay, once you know that there is a problem here, right? So we are going to deep dive return on equity, and after we are done with the exercise, you have to pick up one company, your choice, your company, your choice. Maybe you can take HP also, right? Then calculate the return on equity, see that whether ROE is changing. If it is changing, then why this is changing, that you have to find out after we learn the all the ratios. And then you can also suggest the corrective action, that what exactly we should have done to improve the ratios, right? We'll see that, find that. So return on equity, first of all, let us write down the formula, and then we will deep dive net income available to common shareholder. Why I'm writing common shareholder? Because if you see the equity definition is wide. Equity means preference equity and common equity. Equity means common equity and the preference equity. Like they are lending money to the company, right? But the advantage of preference equity is that whenever we calculate the debt equity ratio, the creditors, the debenture holders, creditors, basically they see that preference equity, when the company at the time of winding up, they get the creditors, they get the priority before the preference equity. Say for example, if you see the balance sheet, no, in US we write right hand side equity, right? Say for example, equity section is there. We have equity, we have common equity, we have preference equity, then we have the, say, loans, right? We have current liabilities, we have here basically all the fixed asset and all these things. So property, plant and equipment. So I'm just writing fixed asset, investments. You have the current assets. So basically these are the assets, these are the application of one. Assets are application of one, whereas this side is basically sources of one, right? Now obviously the at the time of winding up, when the company wind up, that time the first preference is external liabilities. These are all external liabilities. After paying the external liabilities, then the preference equity get the chance to get the money, right? Obviously, if I am lending money to the company, obviously, when I see the preference equity, at least I am safe, right? I say that okay, fine, someone has put the money here, okay, so their preference is my preference is is preferential. I got a preferential treatment at the time of winding up, right? So obviously I can trust the company. That means the financial position of company, when I see, I'll add both the things, common equity and preference equity, and I'm safe that okay, fine, the money basically invested by the common shareholder, preference shareholders, basically they have money, and at the time of winding up I should get a priority basically, right? So obviously preference equity is also important, right? But the finally the net income belongs to the common equity shareholder, right? There are different categories of preference equity also. They sometimes participate in the net income. So anyway, so don't get confused. If you get this type of category of preference shares, right, it's called participating preference shares. It means what? After paying dividend to the common shareholder, if something is remaining, they may participate. That's a different story. But 99% of cases, you won't find this category. 99% of category, you get the preference equity having, they just have the say 9% or 10%, whatever the coupon rate is there. It's a fixed rate of dividend they are getting basically. And we have community preferences and non-community preference. So I'm not getting into now, but let us now think about the ratio. Now common equity. So our focus is common equity. Common equity means you have invested money in the company and you are the beneficiary of whatever net income earned by the company, right? You are the final beneficiary basically, right? So we say net income available to common shareholder, right? So basically what we do actually, net income available to common shareholder means what? Is equal to, you have net income, right, before dividend, right? So net income, whatever you get, minus preference dividend, minus preference dividends. This is now available to common shareholder. This preference dividend means you are paying dividends to preference shareholders, and after payment of preference shareholders, whatever remaining is there, that is belongs to you. So net income is basically net, this is net income available to common shareholders. This is what actually, after subtracting the preference dividend, right? Preference dividend, that is something, the fixed percentage. For example, you have 9% preference equity, and say for example $10,000 is there. So obviously 9% of 10,000, first you have to pay to preference shareholder, and the whatever the remaining is there, that is called net income available to common shareholder. Okay, so I'm not getting into detail about the cumulative, non-cumulative portion. We'll discuss that. Don't worry about it. Just first you understand the logic. Return on equity, right? It is net income available to common shareholder. Okay, and the division is what? Your investment, right? Basically, just like we discussed that net income investment point of view. If you invested money, so basically your investment is nothing but equity, right? Basically, for example, you invested $10,000, right? Same thing, your investment is what? Equity, right? So formula is what? Net income available to common shareholder divided by equity, common equity, common equity. This is very important, right? Not only equity, common equity. Net income available to common shareholder, which is nothing but net income minus preference dividend, okay, divided by common equity. Now these common equity, remember one logic, right? Whenever you are comparing one line item from income statement with another item of balance sheet, if you see the income statement, no, net income is basically daily you are earning, every day 365 days you are going to earn the net income, right? So it's a cumulative total basically, net income, whereas common equity is basically coming from the balance sheet. So how you write balance sheet? Balance sheet is as on particular date. Balance sheet is as on particular date. So all the line items of the balance sheets, right, balance sheet items are static in nature. Static means it is as on particular date what is the item, whereas the net income is basically daily you are earning. So can you compare numerator, which is a daily, versus static common equity? So what we do actually, we take average common equity. And another there is another logic. So say for example, net income you are earning cumulative is growing, right? Your earnings at $100 every day, $100, $100, $100, and it is cumulative. Na? Total is increasing. Tell me one thing: net income, where you will credit? Basically, net income goes where? Net income, return
Sorry,
earning,
return.
return earning, right? So basically, return earning is a part of equity. It means that if net income is growing, right? If this is your equity, for example, if this is your equity, opening balance of equity is this, right? Don't you think so that your equity is also increasing? Do you agree? Equity is also increasing, no? Net income credit to your return earning. Is credit to your reserve and surplus, right? Basically. So basically your that equity is also increasing, right? So do you think that if I take closing equity, it's a misunderstanding, right? It is basically, because I have how much funds have used, my funds, not closing balance. It is I started with the opening balance, right? And it is increasing. And that's the reason we say average equity, right? If the opening balance is say $50,000 equity and closing balance is $70,000, so I say that let us average is $60,000, right? And what we assume here, we assume that the net income, what exactly we are earning is evenly during the year. Then only you can take the average. So this logic, now people don't understand. Evenly during the year. So basically, if I really want to compute the equity for tea industry or sugar industry, right? Basically, during the sugar season, they earn a lot. The seasonal business, right? So maybe you can give the weight also when you calculate equity. I'm talking about the management accounting point of view. Yeah, the management accountant, right? So you can tweak the formula. You're getting my point. Now, these is basically balance sheet item, right? Earlier days I'm talking about, no, we used to get only the opening balance of equity and closing balance of equity. Last year balance sheet and this year balance sheet, right? Current year. So obviously only we used to get only two data. For example, there was no, they don't prepare the interim financial. Earlier days I'm talking about, right? We used to get only annual report every year. So annual report means you get the last year report and whatever the current year. So obviously I get only two data, 50,000 and 70,000. So I used to take the average. Nowadays you get the quarterly data, quarterly performance. So you can take quarterly average. If I get the daily equity, I can take daily average, which is basically makes sense. Daily average makes sense because net income is daily. You are getting my point. If net income is daily, daily average, but not possible, right? Earlier days, people, oh my God, you have to prepare daily net income statement. But nowadays, ERP is possible. With the help of ERP, it is possible. So, in exam, basically, we take opening and closing divided by 2. But I think so, even the textbook should be revised. You should revise the textbook. Now we have ERP system.